Hello and welcome to this weekly market recap for the week ending Friday, May 23rd, 2025. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats. It's a pleasure to be with all of you again this weekend. Just to kind of take a step back, look at what happened last week, where the market seems to be, where we think it might be going. Still got some interesting stuff in the week ahead. Most earnings have come to an end at this point, but we still will continue to get economic reports. We got a PCE report that comes out on Friday, so a lot of folks will be checking that out for any inflation or potential inflation news. The Fed, of course, has been talking about the possibility of a renewed surge in inflation since the beginning of the year. It hasn't happened yet. I don't believe it's going to happen, but for some reason, they continue to talk about it and tout it. And I think that's holding the market back, because if there is no inflation, we should be lowering rates, just like the ECB has been doing. But currently, that's not where we sit. In my opinion, we've seen some manipulation take place again in the last week, similar to what we saw in late March and in the first half of April, actually throughout April, where we saw a lot of gap downs and then buying back later in the trading session. We saw some of that again last week. So I didn't see any real big selling, but we did end the week with some losses. So, read into that, I guess, what you may. But let's go ahead and take a look at what transpired last week. And then let's move forward and see what we think, where we think the market might be going in the week ahead. So let's first start off with the NASDAQ 100. It was kind of interesting last week because if you look at the NASDAQ 100, you see it was the best performing index of the week. And that normally means that some of the aggressive areas of the market do pretty well. But I'll show you the sector rotation in a minute, and it doesn't really line up. So I just thought that was kind of interesting to mention. But the NASDAQ did drop 2.4% last week. Dow Jones almost 2.5%. S&P 500 down 2.6%. Then the more aggressive Russell 2000 and S&P 400 mid-cap indices, both down about 3.5%. Transports, once again, lagging. So it seems to be going back into that, that what we've been seeing throughout not only 2025, but going back the last few years, where transports just haven't really kept up with the major indices. And that was the case again last week. But let's take a look at this grouping of sectors for last week. This was interesting because, again, the NASDAQ did better on a relative basis, which normally means it was a pretty decent week for technology. But look at technology. Technology actually down, underperforming the S&P 500. So I'm not exactly sure what that means. I don't usually see that. Again, just wanted to point it out because I thought it was odd, something a little bit different about last week. If you look at the discretionary group versus staples, staples was the best performer last week, dropping about 0.5%. Meanwhile, consumer discretionary lagged the S&P 500 and was down over 3%. So that relationship between consumer staples and consumer discretionary kind of took a little turn for the worse last week. I'll be talking about that in our weekly market report to our members when we issue that on Tuesday, because I like to look at what happened intraday. So it's one thing, these numbers I'm showing you here include the gap downs. So last week wasn't a great week at the opening bell. Consumer discretionary took a hit on some of those days at the opening bell. Not quite sure that that was the case throughout the trading day, though. So may not be as big of a negative as it might appear on this particular analysis, just looking at the sectors from last week. Anyhow, you can see mostly defensive groups up at the top. You got consumer staples and utilities leading. And then you go down to the bottom and you got energy, of course, which has been pulling back again. Technology, discretionary, two of the more aggressive areas down below. Financials also among the aggressive areas of the market. That too did not perform well. That area didn't perform well. So it kind of looks maybe on the surface a little worse than the week was, because, again, a lot of the selling that took place at the opening bell. But let's keep moving on. Got the 10-year Treasury yield. So I thought it was interesting. If you looked at many of the news stories, anything accounting for the stock market on Wednesday, you probably saw folks talking about the surge in interest rates moving back to the upside being the reason for the stock market decline. Well, maybe it was, but since that Wednesday close, we saw the yield drop again on the 10-year Treasury, and the stock market kept going down. So we're going to blame it on the higher interest rates on Wednesday afternoon, and then blame it on lower interest rates the rest of the week. Again, I think just placing headlines on, moves in the short, in the market on the short term to the upside or to the downside. I mean, honestly, I think that's a fool's game. Let's take a look at what really happened in the market. Let's look at the charts and forget about the headlines and see what the charts are telling us. That's the real story. And so anyhow, I just wanted to point it out because at 1 o'clock, we had the auction of the 20-year treasuries. And you can see immediately the longer term treasury yields shot higher. This is the 10-year treasury yield, but it immediately bolted higher the first 30 minutes after the auction at 1 p.m. on Wednesday. And look at the stock market at that same time going down. So there certainly seemed to be some connection between the two, right? I mean, one immediately goes up in terms of the yield, the other one immediately goes down. So it looks like there was a little bit of inverse correlation there. However, again, after gapping up the next morning in the 10-year treasury yield, we pretty much were going lower the next 2 days, and yet that didn't seem to help the S&P 500 or U.S. stocks. So all of a sudden, that inverse correlation was more like a positive correlation for the next 2 days. So didn't really mean a lot. But to me, I think the key for the 10-year treasury yield is just to stay below 5%. That was kind of a high when we had a surge due to inflation. I don't know exactly when that was, maybe 2 years ago or whatever, when we got up to 5%. We've since pulled back, and we've been trading mostly in the fours since then and kind of get some back and forth action. But I don't see anything in the 10-year treasury yield at this point that really spooks me as far as U.S. stocks go. I mean, if you look historically, these interest rates are still very, very low, and I think are, at a point where our economy can grow considerably with rates at this level. So I'm just not seeing the negative there in terms of, that afternoon spike. And like I said, we've come back down since, and we're actually back down below where we were when that spike occurred. S&P 500, wanted to point out just the technicals here. When we did move up, talked about being overbought. You can see that the RSI on the S&P 500 went up and touched 70, which is kind of the start of overbought conditions. And so anytime you hit 70, you can see here we hit it back in early December of 2024. RSI came down as we pulled back. We hit 70 back in the second week of November of last year. Market quickly pulled back to gap support and the 20-day moving average, and that relieved the RSI oscillator down to almost the 50 level. And you look previous times, this is second week or middle part of October 2024 where the RSI hit 70, and we promptly backed off of that. But you got to be careful because sometimes the market is overbought, but it stays overbought. And if you look back almost a year ago, that's how this played out. So back in the second week of June, we hit 70, and the S&P 500 was about 5,500. It was overbought, but look what happened. We never had a pullback. We just kept going up. And eventually the RSI reached 75, 80. Actually, it looks like maybe in the second week of July, it was up in the 80s. So 70 is an indicator. It's not a guarantee we're going to reverse to the downside, but it's certainly an indicator that tells us the market has run pretty well over the last few weeks. And as a result, we should at least consider the possibility that we're going to pull back. That's what we did last week. Now, what I would say about last week's sell-off, though, is that if you look, and I wrote an article, published it on Stock Charts, you might want to go check that out. But the spider went down, I think $15, or maybe it was $13. And I think it was about $15. Anyhow, over the course of about 4 days. So from last Monday's close to Friday's close, it went down from, well, I could pull the let's just look at the S&P 500 chart for now. But it went back roughly 2.5%. But almost, if you look at the amount of gap downs that we saw over the last 4 days, the gaps to the downside at the opening bell account for almost the entire decline. During the trading day, we really were not seeing much in the way of distribution. We had one day, which was on Wednesday, and that was the day again where we saw the spike in the 10-year Treasury yield. And at that point, from 1 o'clock in the afternoon on, that's where we also saw the S&P 500 sell off. But look at the other 3 days. There was no selling whatsoever. You can look at the candle. You can see basically we had dojis on Tuesday and Thursday, which means you open and close at about the same level. And then on Friday, we gapped down, hit the 20-day moving average on the S&P 500, and then we bounced off of it. So we're kind of looking a little bit here right now like we did back in November after the election. Remember, we had the gap up. We went back down, initially tested that gap, tested the 20-day moving average at the same time, and then went up and took out the prior high. I could easily see that happening again this week and maybe over the next couple of weeks. But, we got to watch. First, I think you have to recognize, or at least I recognize, that we are in an uptrend. And when you're in an uptrend and you've got really bullish momentum, which means the PPO is above the center line and was rising right through to the recent high, telling us that momentum was building as prices were going up. Normally, when you pull back, you hit the 20-day and you bounce. And that's what we did on Friday. And we may have a bigger bounce in store. Now, if we were to go back down and lose, say, gap support at about 56.70 or so, I think that would be a little bit more damaging technically. But otherwise, I'm playing this as an uptrend. I believe we are rallying back in another leg of this secular bull market that we've had since 2013. The cyclical bear market that we just endured, I think, is very similar to what we saw in the pandemic in 2020. Just quick little 4 to 6 week drop, followed by a nice recovery and back to all-time highs. I don't know if we go straight to all-time highs. I wouldn't be shocked if we did, but maybe we go sideways for a little bit. Maybe we get back to 6,100 and change and then kind of go sideways. We'll continue to look at our signals to see what the signals are saying. But right now, I believe that this rally to the upside is fully supported by our signals. I think that our signals are suggesting that this rally is sustainable, meaning that it's going to continue to go higher. That's my feeling on the market, as I look at it now. Looking at it, the other indices, the NASDAQ 100 also back to gap support just above its 20-day moving average. Then we have the IWM, which is small caps. I think went down, put in an inverse right or reverse right shoulder. So coming down off of this trend here to the downside, this is the left shoulder. Here's the left side of the neckline, the head, right side of the neckline, and then the right shoulder. The thing I love about this pattern is that we have a up sloping neckline. If you connect the left side to the right side, which I like to see, I think it just gives it a little bit more of a bullish flavor. And then also look at the right shoulder versus the left shoulder, also up sloping. So it's just giving us, it's giving me this feeling and this signal like this is more bullish than maybe a normal head and shoulder, reverse head and shoulder pattern where the neckline is flat, or down sloping neckline, which I don't like. I don't find that to be very bullish at all when I see a down sloping neckline as a potential bottom. So I think the chart sets up a breakout above 210, 211 on the IWM would measure to an all-time high. Keep that in mind. Mid caps. So we got mid caps essentially even having a stronger neckline. If we get back up and you see us move into the upper 560s to around 570 on that S&P mid cap 400, I think that would be a really good sign on the ETF I'm talking about. And then looking at the transports, we pulled back and transports lagged, like I mentioned this past week, but we're right at gap support, sitting right on the 20-day moving average and pretty much on this channel line that we kind of have started off the April low. So I'm looking for a rebound in transports this week. We'll see. S&P 500, one other look I wanted to just show you is look at the AD line. And this is what, had me somewhat bullish as we were going down back in March and then into April. I wasn't bullish in the sense that I wanted to buy until we got into till we hit that bottom in April. But I was bullish in the sense that I thought it was a cyclical bear market to the downside as opposed to, or a correction. I started off thinking it was a correction. It actually morphed into a cyclical bear market. But whatever it was, I felt like it would be short-lived and we'd go back to all-time highs. That's what I said before we ever even started going to the downside. So that's what I was looking for. That's what we've gotten. And I believe that the S&P is set up with this AD line setting new highs. I think we're going higher. Look at all these hollow candles over the past 4 weeks. Very, very few. Like I said, Wednesday afternoon, we got a little bit of selling. That is the only day since, I would go all the way back to April 21st. That was the only day. Wednesday was the only day since April 21st. So it's over a month. We've had one day, which I think you can look at and say, well, maybe we had a little distribution. Otherwise, when we've pulled back, it's been opening gaps or early in the morning lows, followed by buying in the afternoon. That to me is just reeking of bullishness. And I look for the S&P 500 to go back up and challenge that 6144 closing high that we saw back on February 19th. Or actually, yeah, February 19th. So AD line looks great. Same thing. Look at this. NDX. AD line. Awesome. How about the XLK? Technology. Breaking out, setting new highs. Discretionary. Breaking out, setting new highs. Communication services actually equal highs. Hasn't broken out yet, but internet broke out last week. So it's a very good chance we might see the XLC moving back up to highs and maybe breaking out on their AD line. So keep that in mind. Industrials, not 52-week highs, but off the April low, you can see clearly AD lines improving. Financials, same thing. Got a double top, but improving off that early April low. How about the IWM? Now, this is different because I've struggled with the AD line on small caps and mid caps for the past couple years. We've never really seen a good push to the upside in the AD line. Last 2 months, we've seen a very strong push back to the upside, and that coincides with what looks like a very bullish bottoming pattern. So again, watch 210 to the upside on the IWM. MDY, very similar. Look at the AD line setting new highs. We're still well off the high that we saw back at the end of last year, but we've got signs of serious accumulation taking place in both small and mid-cap stocks, and I think that's good. And then check out transports. As bad as transports have been, look at the AD line over the last two and a half months. Very, very strong, supporting this move back to the upside. And we had a very bullish test of the rising 20-day moving average on Friday as well. All right, let's take a look at the relative rotation graphs because I want to show you the aggressive sectors in the market and just take a look at what was going on at recent tops, previous tops over the last 6 months or so, maybe 7, I don't know. However, going back, this first one will be back in April, so that was 4 months ago. But let's take a look at how the aggressive sectors looked at each of the highs since then, comparing to where we are right now. So this was back in January when we set the first high in 2025. Remember, February 19th is when we set the next high where we went just slightly above where we are right now. But check out January 23rd. So the three most important groups, the discretionary group, technology, and communication services, relative to the S&P 500, had all gone into the lagging sector as we were hitting that high in January. It's not what you want to see. We want sustainable action to the upside, which means we need leadership from these three sectors. We don't want to see them lagging, especially at market highs. That's what we saw back in January. Now we're going to keep moving forward. Now they're starting to get better, get better, get better. And now look at what's happening. XLY is turning back down. Let me go all the way out here. So this is February 19th. This is the next high. This was the ultimate high at 6144. And I want you to look at what's happening. Technology, which had been lagging, finally got some momentum and was just starting to go into the leading quadrant. The other four aggressive groups were all turning and heading in southwesterly fashion. What we wanted, southwesterly fashion. What you want to see is northeasterly. You want to see this moving up and to the right. So it's kind of like, if you're looking at a map, it would, weather map, it would be moving up toward the north and to the east. If, something was, storm or whatever was heading, northeasterly fashion would be up toward the upper northeast part of the US. Anyway, when you're coming back down, it's worse when you are pointing back down toward or in southwesterly fashion. 4 of our 5 aggressive groups were doing just that, pointing down in bearish fashion as we were making our top. And the only one that was bullish at the time was technology, but that's because it was so weak a month earlier. I think we just simply got a little bit of a dead cat bounce in technology, because look at what happened after February 19th. We started to go down. Now look at all of these groups. Now you got financials and industrials at times turning back to the upside. That's the value area of these 5 groups. The aggressive growth area is discretionary, technology, and communication services. And they were all taking it on the chin on the way down. Now here we get to a bottom March 13th. And March 13th was kind of critical for me in my analysis, because I think we had distribution that took place up until March 13th. That's when I think the worst selling hit in the market. And I think from March 13th on is where we started to see that manipulation start to pick up in the market. So if we go from March 13th on this first move back to the upside, look at the aggressive areas start to turn. So we had discretionary moving up, technology was moving up, although it started to curl back there. And you can see communications services starting to move up. That was the first little pushback. After March 13th, we went up, we came back down. And then in early April, we broke down, and that came up right here. This was April 2nd. Here's April 3rd, the 4th, and the 7th. So there is our bottom in the market on the spider. Actually, maybe it was, that's showing the 8th was the low. Anyway, at the 8th, right then and there, we saw discretionary starting to roll back over. Communication services was still moving into leading, and only technology was on the left side. Now, the way you view these RRG charts is you break them up into 4 quadrants. The vertical line here, this is measuring momentum. So when you're up above the horizontal line, it means you have positive momentum and improving momentum if you're over here, leading momentum if you're over on this right side. If you're below the line, then you have lagging momentum. If you're on the right side of this vertical line, it's telling you have relative strength. And on the left side is you have poor relative strength. So when I'm looking at this, I see 4 of our 5 groups. We're right at the bottom. We're at the market bottom. And 4 of our 5 aggressive groups are sitting on the positive side of relative strength. Now, why in the heck would that be? Why would you have 4 out of 5 aggressive risk-on areas of the market that have moved into a position of relative strength when the market is at the bottom? Well, it's the start of manipulation. Money is starting to rotate back into some of these areas. And if were worried about technology, which I was at the bottom, you didn't have to worry long, because as soon as we started to turn back up, look at XLK taking this move. And as we started back up on this move to the upside, what you would expect in a bear market is maybe during a rally, getting a little bit of strength in some of the key areas, some of the key aggressive areas, but then rolling back over and seeing those groups lead to the downside. This never happened. I mean, now as we're continuing to move up, I want you to look at where all these are now positioned. Now we've got technology absolutely powering the market to the upside, moving in northeasterly fashion, which is very bullish, and all of the other groups basically at the center line or more bullish, maybe a little bit to the right, with financials a slight laggard back then. But just keep going toward the top here. And now look where we are. This was May 12th. S&P 500 or the spider at this point sitting at 582.99. But look at the aggressive groups. 4 of them now are in the leading quadrant. And the only other one is financials, which is starting to turn back up in the leading quadrant. And then we get up to the top, and we basically have still 4 of the aggressive groups are leading. 3 of them in particular, discretionary, technology, and industrials. And then the last 4 days, we've seen a little bit of a pullback. And we've seen these groups pull back a little bit, but still sitting well on the right side. Now, what I'm expecting as we go forward is that perhaps we will see some of these groups move back into weakening temporarily and then cycle back up into leading as the market moves back to the upside. That's what I'm expecting. Now, if you are bearish, what you want to see are all of these groups turning around and heading into the lagging quadrant. Short of that, it's very unlikely that you're going to see this market even come close to printing a double bottom and going back and testing that 4,800 level. I think there's almost no chance. I don't ever say never, but I would assign a very, very low percentage chance that this market's going back down there. I think if you get back to 55, 5,600, in my opinion, you should be thinking about being on the long side and count your blessings that you got to pull back to there. If you are new to our show and you're new to EarningsBeats in general, hold on one sec. I just want to point out that you can go over to earningsbeats.com, scroll down, you can start a free, a free trial, or actually just, it's our free newsletter. You can just type in your name, email address. Excuse me. It's still the season of allergies. Anyhow, you can sign up with just name and email address to our EarningsBeats Digest newsletter, which comes out usually Mondays and Wednesdays. We have a holiday on Monday, so this week will be out Tuesday and Wednesday. But we try to make these articles as educational as possible. And I call them articles, but they're really more like a chart in 2 paragraphs. Very, very simple read. Sometimes it's a possible trade candidate if you so choose. Other times it's just focusing on things that are really important to us, just trying to drive home some educational points. But, you know, we've had tens of thousands of folks that have joined us on this newsletter. We'd love to have you join us as well. You can unsubscribe at any time, which is pretty cool. Also, you can join us. We have our spring special going right now. So if you're following this video, go into the description and there will be a link that'll take you to this page right here where we have our spring special. You can save $200 through Monday at midnight. So you've got, from the time of this recording, you still got almost 2 days to claim this offer, but you'll save $200 on an annual membership, which essentially saves you more than 50% if you were just to become a monthly member and pay our monthly fees. Signing up to an annual membership, especially under this spring special, would effectively save you about 50% throughout the year. So this is a great time to follow us. I think you're going to learn a lot about the market over the course of the next year. And hopefully we'll do as we've been doing for the last 5-7 years, which is providing some guidance that's helped keep our membership relatively safe, given all of the cyclical bear markets that we've seen just over these last 5 to 7 years. I mean, we had cyclical bear market in 2018. We had another one in 2020, the pandemic. The trade war was 2018, if you recall. 2022, that was the inflation scare. 2025 this year, which is, I guess, more maybe tariffs, inflation, stagflation, all those scare, whatever you want to call it. We also had the 2023 correction where we dropped more than 10%. So we've gone through a lot in these last 5 to 7 years. And I think for the most part, we've kept our members relatively safe, calling a lot of these declines before they ever happened, and then getting our members back in pretty close to bottoms. So if you want to experience that, try us out for the next year. This is a great time to do it because we are running our spring special through Monday at midnight. So make sure you check that out. And again, that's in the description. And for those of you who are just following along, maybe learning more about us, maybe can't afford our service, whatever that is, everybody, if you could, hit that like button. That'll really help us with our algorithms at YouTube, and definitely subscribe to our channel. We do a lot of events. Sometimes they're live streaming events. And as soon as we either upload a recording or we start a live streaming event, if you are subscribed, you will find out immediately on YouTube. So don't miss another show, another episode. Make sure you check us out. Hit that subscribe button and also hit that like button for us. A couple more things before we wrap up here. I wanted to mention cryptocurrencies have been on fire. I don't trade cryptos. That's not really something that I've studied and researched. That I'm not an expert on cryptos. But what I do like to follow about the cryptos is that they tend to be more risk on type assets. So whenever the market is in a risk on environment, it tends to benefit these cryptos. And it also benefits the stock market at the same time. So there's a little bit of a positive correlation between Bitcoin and some of our, aggressive versus defensive kind of ratios. And I wanted to point that out on a chart here. So this is Bitcoin going back the last 5 years. On the chart below here, I show discretionary relative to staples. Discretionary is aggressive. Staples are a little bit more defensive. And then at the bottom here, I have a correlation showing you the direction of Bitcoin and the direction of this ratio, showing how often they're positively correlated versus negatively or inversely correlated. So, I mean, you can just eyeball this. When Bitcoin is going up, when it's in uptrends, generally the XLY, XLP is also in an uptrend. Here, Bitcoin back in 2022 is in a downtrend throughout that cyclical bear market. So too was this ratio. 2023, money started rotating back into crypto. So again, money was risk on, and you can see that clearly in this ratio going back up. We had a little bit of a period where we kind of went sideways to down in 2024. Essentially, same thing happened in the XLY, XLP. And then when we rallied in the fourth quarter of last year in crypto, we did the same thing in the XLY, XLP. Then we dipped, came back to a high, and that's exactly what we did again with the XLY, XLP. We dipped, haven't come back to a high, but certainly starting to move back in that direction. And this bottom panel down here, this is what's showing us the correlation. What I like to do is to kind of highlight, I didn't do it here, but if you highlight and just look at how often the correlation between these two goes above 0.5 and gets up to 1, 1 means that they're perfectly correlated, that when one goes up, the other goes up. And this is over 20 periods. So in this case, we're looking at a daily chart. So it's comparing the direction of crypto or Bitcoin to the direction of this ratio over a 20-day period. And it just plots it on here. And you'll see that there is a lot of time spent above 0.5, many times above 0.75, and even occasionally we approach 1.0, meaning that they're going hand in hand for 20-day periods. If you look toward the bottom of the correlation, you'll see that there are very few trips past minus 0.5, and we've never really gotten all the way to -1. We got past 0.75 really on just one occasion, minus 0.75. Whereas you can see many, many times we went above the positive 0.75. So again, what I'm just pointing out is that Bitcoin is viewed as a risk-on asset. So anytime we see Bitcoin going up, remember, we just set an all-time high last week. When we see Bitcoin going up and setting new highs, that bodes well. That makes me think really bullish thoughts about the stock market. And so that's just one other signal. I mean, I have a lot of signals I follow, but this is another one that I've really started to follow more often over the last couple of years, as I've noted the positive correlation that we tend to see between the two assets or asset classes. All right, gold. A lot of folks liking gold. And of course, we had a big bounce back in gold last week. A lot of folks may be thinking gold's just going to keep on moving up. I think on a relative basis, I think gold is rapidly dying a death. It's not to say I don't think gold goes higher on an absolute basis. I just don't think gold is going to keep up with the S&P 500. I believe the S&P is going to jump back to all-time highs, and I think gold will maybe go sideways for a while. I think it will lag again. You can see that there are a couple things, I talk about this all the time, but there are a couple things that really drive gold on a relative basis versus the S&P 500? Two things. One is the dollar. When the dollar is weakening, that is a great great tailwind for gold to outperform the S&P 500. Look at the dollar coming down this year. This is the panel on the US dollar when we topped on January 13th and we came all the way down and we bottomed on April 21st. And during that period, during that decline, it was a pretty steep decline in the dollar. Look at the relative strength of gold. We topped out, we had the high relative close on April 21st, which marked the low of the dollar. We had what appeared to be a pretty significant low right in here at the beginning of the year, just as we were getting near the top on the dollar and rolling over. The other thing that drives gold is when the volatility index takes off, because that fear drives folks to a hedged position against the S&P 500, and gold is one of those hedges that traders look for. So as we went into March and April, actually even in the latter part of February, gold had the benefit not only of the dollar going down, but the stock market going down was creating volatility index to go up. So we had a falling dollar and a rising VIX, the two ingredients that you really want to see if you're going to invest in gold. That's when you're going to outperform the S&P 500. We had both of those. The dollar, though, bottomed in mid-April, bounced. It's starting to come back down again. That 98 level is going to be really important for me in terms of the dollar. If we don't hold $98 and we break below 98, that will be a good thing for gold. And I'll also be watching the stock market because I don't think breaking down below 98 would necessarily be viewed well in terms of stock market performance either. So even though, I'm bullish and I'm, been bullish since early part of April, and really I stay bullish longer term, but I'm talking about in the short term, I turned bullish again in the early part of April. I still recognize things that could change the market, and I want to be prepared for them. One of those things would be the dollar going down below 98. So I'd keep an eye on that. The other thing that happened this week is volatility index picked back up again. So we had the dollar going down, the VIX turning back up. That is a good thing for gold. And so gold made another run toward its high in a week when the S&P was going down. So we saw outperformance by gold. Watch the dollar. I think the dollar is going to be critical. If the dollar continues to hold 98 and breaks back up above this 102 level, I think that would be very bullish for the dollar and very, very bearish for gold on a relative basis. I think it would be great for the stock market. Likewise, I think if the VIX fails to really move much higher to the upside, if the stock market starts to recover and the VIX goes back down below this double bottom at 17, I think the bears are in big trouble. I think that would be like a final nail in the coffin as far as the bearishness in 2025 being in our rearview mirror and confirmed behind us. So those are a couple things I'd be thinking about with gold. Got to talk about inflation because, again, we got the PCE coming out later this week. I think it comes out on Friday. And for the last 2.5 years, 3 years, the Fed has been talking about trying to get this sustainable move in inflation down to its 2% target. Well, let me just show you where we are right now in that quest to get back to 2%. This is a 12-month rate of change in the core rate of inflation at the consumer level. We were up to 6.7%, and we have come down almost every single month since probably the third quarter of 2022. That's almost 3 years worth of steady decreases in the annual core rate of inflation, again, at the consumer level. And yet the Fed is still talking about the possibility inflation's going to surge and that we need to be vigilant and that, can't cut rates because of inflation. If you listen to what the Fed has said over the course of the last 3 or 4 years, you could not possibly come up with any conclusion other than they don't know what they're doing. Or that they're just so confused that they're just throwing their hands up and I mean, for a while, it was, at the top, they just wanted to see inflation starting to roll over. It did that. It did that easily back in 2022. Then they wanted to see it for a few months. They wanted to see a sustained move to the downside. Pick your spot. I mean, it's been sustained to the downside ever since 2022. So I don't know. I mean, you could go out later in 2022, throughout 2023, throughout 2024, whatever, and it met that goal. And then they came out at some point and said, we need to see a sustained move toward 2%. And they've been talking about that ever since. And I'm just looking at the inflation number. We're at 2.78% now. We were at 6.7. How much further do you have to go toward 2% to have a sustained move toward 2%? I mean, listen, if you're worried about inflation or you're worried about certain things taking place, just say that, but stop this sustained move toward 2%. I mean, it's getting really old after almost 3 years of seeing it move in a sustained path toward 2%. But again, that's just me. When you come down, this is the 1 month rate of change, and you can see how it spiked. And of course, 2020, 2021 is where we saw the big spikes in inflation. And since then, we have been working our way back down. If you look at history, this is how inflation ends. We come down, we have little bounces that make it look like inflation's moving back up again. And then we come down and we eventually work our way down into a very, modest 2% annual rate of inflation. And that occurs by having an average of about, 0.16 needs to be the monthly CPI over 12 months. 12 times 0.16 will get you pretty close to 2%. And if you look, we've already had some of these readings show up below that 0.16 level. We've had a couple spikes, but last month, 0.24. And again, right now, annual rate 2.78. Can't make this stuff up. I don't know what the Fed's looking for. But anyway, just keep listening. So some stocks. I just want to go through these really quickly. I know this is a pretty long session today, but I want to go through some individual stocks and just show you some of the stocks that we're looking at that we keep on our chart list. These are all stocks that are on our bullish trifecta chart list. The bullish trifecta chart list means that these stocks are on the strong earnings chart list, they're on the strong accumulation distribution chart list, and they're also on the raised guidance chart list. Those are 3 really important chart lists to be on, number one. And to be on all 3 of them is how we developed this bullish trifecta chart list. So these are some of the stocks that I think look really interesting on this chart list. Most of these, as I go through, you'll see strong AD lines or at least strengthening AD lines. You're going to see stocks that have been breaking out, maybe pulling back, getting close to key support levels. And so I just want to go through them real quick. So the first one is ATGE. This is at Adtalem Global Education. Huge move up just a couple of weeks ago. We've pulled back. I think gap support in that rising 20-day moving average would be a great entry point if we get there. Let's see. Oh, shoot. I just got rid of all the stocks that I was looking at. Let me go in here. I can probably pull them out for you. At least I'll pull out some of them for you. So the first one was ATGE. The next one I wanted to point out was Broadcom. You can see, I think this is a nice bull flag. So straight move up, that's your flagpole. All of this sideways action is the flag. A breakout above 235, I think this thing could really run again. So watch AVGO. Next up, Boston Scientific. AD line's been strong. Keep in mind, Boston Scientific is part of healthcare, and healthcare stocks have been clobbered in 2025. This is one of the exceptions. It came down recently, tested the 20-day moving average. It looks like a little bit of a maybe a deformed cup, but a cup nonetheless, where we go up, come down into a cup, back up, equal highs, go into a handle back to the 20-day, and I would be looking for a breakout above 107. If we get it, this would measure up to 127. So pretty strong looking chart to me. Next would be CyberArk Software. Love this one. This was in our portfolios last quarter. Didn't make this quarter, but I love the breakout nonetheless. AD line surging to a new high. Just broke out above 370. I think this is going to run to 420 over time. Might not happen right away, but I think we're heading back toward that 420 level, maybe a cup off of this extended uptrend. Next would be Duolingo. This was probably one of the most bullish charts after earnings came out this last quarter. This was the candle after earnings, just this huge move up. Check out the volume. It was the third highest volume day of the year. We opened up and we just kept going up. And since then, we continued going up. There's a lot of demand for Duolingo. I think we're kind of going sideways. Maybe we get a 20-day test. That would be good for me, probably to take a shot on the long side. Let's see what else we have. Here's a stock in the biotech space. Biotech's been horrible, but EXEL breaking out. Its AD line broke out. It's been pulling back here recently over the last week to 2 weeks. But look at the volume on the move up to the upside from $37 to $49 in 2 days on 2 of the heaviest volume days of the year. If money ever rotated back into biotechs, and down here you can see, look at the biotechs relative to the S&P 500, just going down, setting a new 52-week low. But EXEL is a massive outperformer within the group. So if money starts going back to this group, this is a stock that absolutely could go back up above 49, set some new highs. Watch gap support, top of gap support, and this 20-day right around 41. Next, Howmet Aerospace. Look at AD line, perfect. Stock just keeps going up. This has been such a steady performer to the upside. Once again, I like it on a 20-day test, but we haven't had one of those even for over a month now. IBM recently pulling back, getting close to that 20-day moving average. I like the AD line. Beautiful move up. This was a gap down after earnings. They came out with great results. I said at the time, I thought that was the time to maybe perhaps get into IBM. I love that pullback at the open after reporting really good numbers. And we went almost straight up after that. And now last week pulled back close to that 20-day moving average. IDCC, this is a semiconductor stock, which has been a pretty decent performer. But here is the AD line ready to break out. Nice little hammer right around the 20-day moving average and gap support. I would expect to move higher next week. All right, let's keep going here. Pod, which is Insulet Corp, AD line going up, and that was another very, very, very strong reaction to earnings. Earnings were off the charts in terms of beating estimates, and best volume of the year by far accompanied this move to the upside. Market makers, even though they tend to start off on the other side of the trade when we get gap ups, they could not get control of this action on the short side. The buyers swamped them, and we continued moving up. I see this stock going higher in time. Let me pull up one more. Roblox, another great one. AD line moving up. Very stretched in the near term. But again, watch for maybe anything back in the 74 to 76 area to test price support and that rising 20-day moving average. That could be a great entry into Roblox. Anyway, that is essentially what I have. Again, coming up this week, we're going to have our second estimate of GDP that comes out on Thursday. And remember, the first one came in below expectations and was negative, came in at minus 0.2. So we want to see if the second reading confirms that first reading. You know, are we still negative in terms of GDP for last quarter, or maybe is it going to be revised back to the upside? That comes out on Thursday. Could be a market mover. And then Friday, I think probably the bigger of the economic reports out this week, because it does deal with inflation. It is a gauge that the Fed likes to follow. And that is the PCE expenditures. So we'll see what happens with that on Friday. But in the meantime, like I said earlier, I think this market's been manipulated to the downside. AD lines have been surging. I think there's a lot of accumulation taking place after gap downs. And I believe in time we're going back to all-time highs. That's it for me for the weekend, though. I'll see you next week. Have a great week ahead, and happy trading.